Welcome right here, guys. So, my name is Divine SM. So, welcome to my YouTube channel. So, what we'll be doing this season we are creating a series on trading. All right. So, we'll be starting with the beginner series. So, this is the beginner series. So, what I'll be first of all be diving into the beginner series. We'll be talking about the like I'll be introducing you to forex trading, like introduction to forex. All right. So this introduction to forex is just the beginner series. We are also going to have the intermediate series where we talk about support and resistance, talk about Fibonacci retracement, candlesticks, you understand, chart patterns and the rest of them, and how you can use the retailers concept to analyze the forex market. All right, so we also talk about the advanced series. That is where we'll get to teach you the strategy that I use, which is just basically market structure, liquidity, point of interest, and exit and exits. I also talk about the directional bias. All right. So then we'll now talk about the risk management part of things, and we'll also talk about the psychology part of things. All right. So this is just the beginner series, and this is episode one. So don't forget to, if you find this content amazing or if you gain value from this content, don't forget to like and subscribe to this YouTube channel. All right. So my name is Divine SM. So we'll be talking about forex trading. So basically, forex trading, or let's say what is forex? Forex is just an acronym. Right? That is very simple. When you want to keep it simple, forex is an acronym. Let's just say forex. Sorry, forex. I say forex is a what acronym which stands for what? Foreign foreign exchange. That's just basically what forex is. Forex is an acronym for foreign exchange. Foreign exchange. So foreign exchange is just how you exchange like national currencies against each other. Just like let's say for an example, a we're exchanging pounds against USD. That's also foreign exchange is. All right. So foreign foreign exchange. Then we'll talk about forex trading. What is forex trading? Forex trading is a global market. Come, let me see if I can write it down. Foreign forex trading. Okay. Forex trading is a global market, or you can say it's a decentralized market, right? Global market where national currency currency are traded against each other. So that's just what forex trading is. To make it simple, forex trading is a global market where we trade different currency against each other, like different national currency against each other. Alright, so forestry, this market is not like a physical market. It's not like a physical market where you go to the market and just like it's a decentralized market. It's in like in the financial world, you know what I'm saying? So it's not a physical market. So it's just basically a global market where currency pairs are traded against each other. And what we trade in the forex market is basically currency pair. What we trade in the forex market is currency pair. Currency, currency pairs. That's what we trade in the forex market. And what are currency pair? Currency pair is just the exchange rate. We call it. I can do something. It's the exchange rate between two or more currency. Let me increase this thing. Okay, let me start from. Okay, I'm coming. Let me write it down. I say currency pair. Currency pair is the exchange rate between two national currency. The exchange rate between two national currency. That's what we trade in the forex market. You are trading a national currency against another currency. So that's basically what currency pair is. Which means, okay, let's say for an instance now, we are using pound, dollar. Let's say we are trading pound against dollar. So we are saying that if we are buying pounds, we are expecting dollar to drop. So if dollar drops, we are expecting pounds to increase in value. And when we buy pounds and dollar drops and it happens to go in our favor, we make money. So when we are selling pounds, we are expecting dollar to increase. Pound, dollar, we are trading pound against dollar now. So we are expecting pound to increase. All right. So we have major currency pair, we have major currency pair, we have minor currency pair. The major, I'm just going to talk about the major currency pair now. Major currency pairs, sorry, major currency pairs are multiple. We have like pound, dollar, pounds, pounds slash dollar. And in forex, we have like they have a way we have symbols for them. We have symbols for them. So when we want to, like say for pound dollar now, what we see is GBP USD. So this GBP USD, the G there, they are just picking every first letter of the of the currency. Let's say GBP now. That G is for stand for Great B, British, and that P for pounds. Why the US dollar is just the United States dollar. So we are trading GBP, which is pounds against dollar. So that is just what it means. We also have another one for, I'm sorry, we also have another one, Euro USD, Euro slash USD, sorry, USD. This is the another one. So this is just, if you look at it, we are saying Europe. That is what is Europe now. European, whatever, Euro against USD. So that's what Euro USD stand for. But normally this O is not among it. It's just like this Euro USD, Euro USD. So we have another one like USD JPY. Sorry, USD JPY. So USD JPY just stands for the USD there is the United States dollar. Why the JPY is the Japanese yen? The Japanese yen. I told you that they pick every first letter, like the Japanese. This JP stands for Japanese, why the yen, the Y is for yen. So Japanese yen, we are trading dollar against Japanese yen. So let's say we are buying dollar, we are expecting Japanese yen to drop. We are expecting Japanese yen to reduce in rates. Why? Dollar increases. So when we are selling USD JPY, then we are expecting USD JPY, we are expecting yen to increase while dollar drops. Get what I'm saying? Right? Just like that. Just like that. We have major currency pair. We have GBP USD, we have Euro USD, we have Australian dollar. That one is for, let me put that one. AUD, Aussie dollar. You can say Aussie dollar, AUD USD, Australian dollar. So Australian dollar, USD JPY, we have dollar Japanese yen, we have Euro USD, which is Euro dollar, we have GBP USD, pound dollar, and we also have okay NZD USD. We have all those NZD USD. That NZD USD just start for like okay, I'm coming. When we get to the main place we are going to talk about it, I'll show you. So that is just basically what currency pairs are. Currency pairs are. So these short names for them are just what we You know what I'm saying? Forex. That's just it. That's just it. All right. So pounds, GBP, dollar, USD, euro, EUR, Japanese yen, JPY, Australian dollar, AUD. Just like that. That is just ITs. That is just ITs. We have Switzerland. We have Swiss. We have CAD, Canadian dollar, CAD. CAD. We have CHF, Swiss. That one stand for Swiss. Just like that. That is just what currency pairs are. That's just basically what currency pairs are. Alright. So I'm coming. Let me just move this thing. Let me make it bold. Let me make it bold. So from currency, and one of the things is that currency pairs, how do we calculate? Okay, let's say we want to calculate the move that a particular currency pair makes at a particular time. That is when it comes to pips. Pips. The currency pairs move in pips. The forex market move in pips. Yeah, the same way human beings take steps. Like if I'm walking, I'm taking steps. Why the currency pair they move in pips. They move in pips. So what is a pip? A pip is just um, pips. Pips. So then what is a pips? A pips is the smallest movement of an amount of a currency. Pips is the smallest movement of or amount, sorry, of the amount in a currency pair. In a currency pair. So pips is how the how currency pairs move. That is how we calculate currency pair. When I want to calculate how many how long does it take for how many movement is a particular currency pair took to get to a particular place or a particular price. That is when pips comes in. So pips is used to calculate the value, not just the value, it's used to calculate the movement. So in our next series, we'll be talking about the value, how to know the value of each pips. We'll also be talking about lot sizes. Get what I'm saying? We're talking about lot size. We'll also be talking about leverage in our next series coming. So just be prepared for it. So what we are just where we are going to stop is just a pip and how to calculate pips. That is just what we're going to talk about in this series. Then we'll close this particular series. Then wait for the next series to come. All right. So don't forget that we are still in the beginners phase. So if you find this very interesting or you find this content amazing, don't forget to like, subscribe, share if possible. All right. So now we're talking about pips. So I say pips is the smallest movement of an amount of a currency. So it is used to calculate the movement of a currency. That is what we use pips for. All right. So how a pip is calculated? Let's take for an example. I'm coming. Let me take out my drawing tool. Let's say euro. We are using euro USD for an example now. Euro slash USD. Let's say euro USD move. Let's say the current price is 1.240. Let's say this is the price of euro USD right now. Like this is the price of euro USD. And maybe let's say we are taking a trade. For an example, now we are taking a trade and this is where we want to enter from. This is our entry price. This is where we want to enter from. And our target, how to now know, okay, now we'll talk about stop loss in our next, we'll talk about stop loss and take profit. Like position tools, we talk about all those pending orders, like orders in the market. So how to calculate in an order, what we use in an order is that when you are getting into a trade, you need to set a, let me just talk a little about stop loss and take profit. A stop loss is an order you set in the market or set in market that, okay, if in case, you are telling the market that if in case price like my analysis is wrong and market is going against me. Once it get to this particular place, take me and stop the trade. I'm okay with the loss. Stop the trade. Why you take profit is just another that you said that okay, if the market happens to go in my direction, this is the particular place I want to take profits from. And so that's why pips is very important. Pips is how we calculate the how much you are risking on a trade and how much you are starting to get. All right, let's say this is our entry price. We want to take a trade on Euro USD, and our take profit is at we are buying Euro USD when two 500, 500. How do we know how many pips movement is this price? How do we know how many pip movement for price to get to our take profit? Now, so basically, how I do my own is that you can use your calculator. You can use your calculator. That is very easy part. We just that when you are using your calculator, this point you are removing this decimal point. It will just be 12460. You now say 12460 minus the target 12500, 12500. Then you get your pips. But basic way I do my own, the basic way I do it is this. Like okay, let's say we apply what we learn in school. We can be like okay, 100,000 unit. Here is your one. Here is your 10. Here is your 100. Here is your 1,000. Here is your 10,000. So that's just how I calculate my own. So if price, as far as price is, if any movement that price makes here, I'm calculating it as just one movement. So let's say as it is 0 now, if it moves to 2, it's just 2. So as far as it's not above 10, it's just like 1 to 9. So we can just take it like that. 10, we can just say 9. If it moves, if that 0 changes to 4, we'll say it move 4 pips. If it changes to 9, we say it moves 9 pips. So that is just basically what year is for. Why this place, which is my 10? Let me put the 10. This place, which is my 10, is that this place is just from 10 to 90. So let's say here is 0. We know that, okay, nothing is there. Here is 60. 60. Here is 6. So B is under 10. So 6, yeah, this 6 means 60 because it's under 10. You get what I'm saying? It's 60 because it's under 10. So we'll say, okay, from here like this, market only move 60 pips. It only moved 60 pips. You get what I'm saying? 60 pips because this is our 10th. This is our no, this is our one, this is our 10th, this is our 100. So any movement my price makes here, we are calculating it in hundreds. Any movement price makes here, we are calculating it in tenths. Any movement price makes here, we are calculating it in like one, just one particular currency, just one. That's what we are calculating it in. All right. So for example, okay, we say here is 0, here is 6, which is 6 in 10. 6 times 10 is what? 60. Here is 4. 4 times 100 is what? 400. That's just it. 2 times, here is your 1,000. Okay. I don't want this thing to be all right. Here is your 1,000. Here is your 100. I just want you to think like that. Here is your 100. So 4 times 100 is 400. All right. Yeah, 4 times 100 is 400. 2 times 1,000 is 2,000. Get it? Just 2,000. So if this changes, we are calculating it like in just one figure. Let's say here is okay. Let's use this one for an example. So we want to calculate the pips. So here is 0, which is telling us okay 0. Here is this equal to 0. All right. 10. So this thing moves from to 0. So here is now 0. So because it's 0, it doesn't mean anything to us because this is 0. Here, so this 400 moves to 5. 400 moves to 5. So that is like, okay. So, sorry. So, I'm sorry. I'm coming. Let me do something. All right. So, 6. 6 to 10 is what? So this is now 10 because this 400 has changed. This is like 6, 7, 8, 9, 10, 100. You get what I'm saying? 100. So if we minus 460 here, this 460 is just telling you, okay, 460 pips. If we minus 460 pips from 500, giving us how much? It's giving us 40 pips. Because this is only where the changes happen from this 460 to 500. That is only where we're interested in because this area, this side and this side, they are still the same. So as far as they are still the same, we are not interested in that part. We are only interested in the part where price change, like where the price changed. All right. So 460 was the current price. Now we are aiming for 600. So what we will do is that we will only take 460 because that is the only place that price should. RDB, like it is always this. RDB here will see 500. And we will only focus on this area that changed. But because this four change to 5. So we are only interested in 460 and 500. So 460 minus, or let's say 500 minus 460 is giving us 40 pips. So we now say, okay, price moved. Okay, our target is 40 pips. Get what I'm saying? Our target is 40 pips. So that is just what I'm trying to say. All right, let's do another one now. Let's say we are let's use GBP USD for another example. GBP. You can just say GBP, sorry, GBP USD. GBP USD, let's say price move from like this is the current price, like 1.0800, 1.0800. And we want to calculate the pips for the pips movement for 1.8720. So what I'm saying is this is the only place price moved. This is the only place price moved. The rest is still equal, still the same. All right, so 800. This is 8,000. Sorry, 1.8 thousand and 1.8720. So initially, when you look at this thing, you know that okay, price move is 720 pips. It's because it's only 720 that was added to 800. All right. So here is our 1/10 and 100. 1/10 and 100. So if we want to calculate this thing 0.00800, 0.008,000, sorry. So from 8,000, this is what was added to it. Initially, nothing is, let's just say this is 0.000. So imagine I'm adding 720 to 8,000. We already know that this is 720 pips. So the market move is 720 pips. All right, so also in currency pairs like JPY, those currency pairs that has JP and Y, their pips calculation are quite different from this other one because they have like 3 decimal points if I'm not mistaken. Yeah, let's say for an example, a pair with JPY, we see price in something like this 159 point. This is a point 20. So you can see that this price is quite different from the former one. All right, it's quite different from the former one. So it's still the same calculation you use. I tell you that if you want to use calculator, you remove the decimal point. If you want to use your calculator, you remove the decimal points. If you don't want to use your calculator, then that's good. So here we see be our 10. Here is our tenth. Here's our 1/10, 100, 1,000. 2,000. That is just how it is. All right, so let's say we want to calculate the movement for this now. Let's say price is now at 160.10. Let's say price moved from year to year and we want to calculate the pips. We say yes, our one. So nothing changed in one. Yes, here was 0. Nice. 2. These 2 represent 20 because we are dealing with tenths. We are dealing with tenths. So price moved from 20 to 1. Let's tell you 10. Here is now 10 pips. Here is 10 pips. This one, this 0 is nothing. Let me clean it. Because nothing shifted from there. Nothing shifted. Nothing shifted. Nothing shifted. Or you can just put it like this. You can just put it like this. This is 20. 20. If you minus 10 from 20, what will be left? 10. So here is 10 pips. So here is 5. Here is 9. Don't forget we are dealing with 100 and 1,000. 100 and 1,000. That's what we are dealing with. 100 and 1,000. 100 and 1,000. So this is 59. Minus 59 from 60. What will you get? 1. You will get 1. You will get 1. Yeah. So when we want to calculate this, we'll say that price moved 110 pips. 110 pips. 110 pips. 110 pips. So price moves 110 pips. 110 pips. So basically, that is just we are going to still talk a little about it. I will also show you in live chat how to calculate it as well. But this is just basically how it is. This is just how to calculate your pips. That is just how to calculate your pips. All right. So in our next episode, we'll be talking about leverage, lot size, how to know the value per pip, how to know the value per pips, and so on and so forth, just like that. So I still remain Divine SL. See you in the next episode.